Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, May 29th, 2024. It's 9:36 a.m. Eastern Time as I'm starting the video. Told you I'd get one out to you early today. Was out of town yesterday. Had to go take care of a relative who had surgery. Surgery went better than expected, so I'm back in town, and very happy to be in front of all my charts and having multiple monitors again, and all my screen draw tools. So I'm going to get this video out to you, and I'll follow up with other charts. I'll get to the other trade ideas. I'm going to just kind of ad-lib in this right now. I'm going to start with the indexes. Where did this go? I need to flip this over to an hourly chart. I'm doing this one starting out with the small caps. Last week I got out to a objective short entry trade idea on RTY or IWM if you trade ETFs. Me, I'm a big futures trader, but I will trade both in different accounts. But that's just where you're going to pick up little nuances on the futures because they're trading around the clock. I always say, different reaction points, and you can see additional trend lines, support resistance levels. And so I encourage anyone that trades ETFs to also chart the futures and again, to see those levels that you might not be able to see when you look at the 9:30 to 4 p.m. trades on the ETFs. Or the indexes. So RTY sell signal was to come on a break of that 2097 support. First target 2061, second target here 2035.10, which is now hit. That gives us a 3% gain on that. We say cover a hair above the actual support level you're targeting. And so what I want to point out, that's why I'm starting out with this one. If you want to book profits, it's about exactly a 3% gain so far. There was your breakdown. Let me change my tool color here. Go back to this one. That was the setup there. There was your breakdown, short entry. If you missed it, you had another chance on the objective back test. Then we took out the trend line I gave you there. That was an additional sell signal push back. If you missed that, you had a second and third or fourth and fifth objective reentry, both back up to that 2097 level. Which again, support once broken becomes resistance, and then the downtrend line, which I since added. Here, it's just that chart right here. So that's it. So we've hit that 2035 level. I just wanted to get that out quickly. If you want to book profits, I also gonna segue over to the short-term charts. Last was on Friday. It gave you objective short on NQ. Any pushbacks to that 928 level, we were right there, and/or on a break below that trend line. We went up about exactly a quarter point above there. Markets were closed, so we had, even though I posted as an active trader setup, we had 3 days of a 3-day weekend, and so the futures would trade a little on Sunday night and Sunday evening, but nothing. Our final target on that setup was down here, which what is that? Here's my lines right here. If hit, that's be about a 1.5% drop, and so 0.25% upside, well within any reasonable stops. In fact, that's a 6-to-1 RR just right there alone if you give yourself at least a quarter point on the stop. So, and then what happened since then? Again, this is why I do these videos. I always say charts are dynamic, and so is my analysis. This is what I got out to you yesterday when I was out of town working off my laptop remotely. But so that was the little breakdown there. There's a pretty significant resistance. This is just weekend noise. There's hardly anybody trading on Sunday evening on the futures, so they drift a little higher again. Barely. We're talking a quarter point from the entry point here. And they gave us this big wedge right here, that beautiful bearish rising wedge. So that's what I wanted to point out. And I did point out to you yesterday. I just had the crude annotations. There was a breakdown of it. And then we went on. Well, we hit that first target right away on Friday. We hit it again. That was 839. Then we hit it again. So that just goes to show, if I thought it was support back there, it's even additional validations, multiple tags, even another brief punch there. We didn't even get, this is just a 5-minute chart. Those are white candles down below, meaning the shadows. So you closed on it, and then finally broke it here with a solid 5-minute close below. And the way, again, this is simple stuff, guys. The way it works, there's no guarantees to any of this, but support once broken then becomes resistance. And support once broken provides an objective short entry. So once you broke it, especially on that 5-minute closing basis, you went right down to T2. T2 was hit. You could have active trader, could have, just like you could have here, book profits, game to bounce. You could have also done it here. And so we got a bounce. And it was more so consolidation. I always say I call this a reaction. I define a reaction as one of two things. When you're going down, you hit a support level, you either bounce or you consolidate, or it's usually a little of both. So I always say you can consolidate in time and or price, or a combination thereof, and that's what you did here. So bounce, bounce, and look where you bounce to. You bounce back to the former T1 level right there, which again is resistance 18,839. Give you another objective short entry, went down through there, bounced back, and so here's where we're at right now. So we are at that downtrend line. That's what I got out to you today. And certainly if that gets taken out, it's pretty well defined. That could give us a counter trend rally. Now, this is important. I have been speaking to, and I'm going to continue to speak to, because I get this all the time. This is a 5-minute chart. This setup here with these, one, 2, 3, 4, 5 targets I gave you on Friday. That was a active trader setup. Here it is. That was the chart from Friday. However, on Thursday, I mentioned that we had bearish engulfing candles put in on SPY and QQQ. Mentioned it during the day, and that if we closed with them, then you have one of my favorite, absolute, just one of the best patterns in trading, I think, or sell signals you can get. And again, we're in an uptrend, primary, larger uptrend. And so, as I said on Thursday, and I'm just repeating myself, that even if you want to say the odds are less than favorable, less than 50%, the risk reward is just downright phenomenal. Because again, if you shorted on Thursday, and this is again a swing / trend trade, that was pointed out on the daily time frame, not the little 5-minute charts are a world of difference. However, those two trades are not necessarily mutually exclusive. You can use the 5 and 15-minute charts to kind of hone in, game your entries and exits, and refine it, active trade around it. That's what I'll do. If anything goes from point A to point B on the daily charts, the bigger picture, longer term targets, it's all but guaranteed as an active trader. I'm going to be long, short, trying to game the zigs and zags. However, not everybody does that. So, just to reiterate, as I will continue to do so, it's simple. With QQQ and SPY, I said maybe give it a little bit of room, because that's what they do nowadays, and punch above those highs. So whatever I said on Friday, whatever you want to give it, 1, 2%, 3%, the RR, if you risk 2% on a stop loss to make, again, what could easily be, if T5 is hit, that's going to be a 16% drop. That's an 8-to-1 RR, which is exceptional. And so I'll take those all day long. And if you take 10 of those and only 3, 4 play out, you're actually, if you're using those good risk reward ratios, you're going to make money. So that's one trade. And then, again, the, active trader may just be looking at the 5-minute charts and the 15-minute charts that I posted. So there's your update. I just wanted to give you that fact that IWM, like I said, or RTY just hit support. Let me look at the IWM 60-minute chart. I haven't actually had time to do that. So there was it. Last update I would have given you was on IWM 60-minute chart. We had a divergent high. This little bearish rising wedge right here, defined by the divergence line and the uptrend line, with a breakdown back test, provide an objective short entry as well. That was that level I gave you on RTY earlier that I just covered at the beginning of the video. Then we broke support, went down, and you can see I'm going to move this line right now, even though that was a target there before. I'm going to put it right here. Why did I do that? Because I had a reaction. I always say charts are dynamic, constantly changing. My analysis is if I add levels or modify a support level, I'll do my best to let you know. But now it fits better. I see support here, support there, resistance here on that trading range, resistance, a big breakout candle, very impulsive rally when you took it out, back tested it from above, back tested it from below once broken. Most recent reaction high, the two most recent reaction highs, and look, now we just gapped down above it. So where we're at right now, that's why I wanted to get this video out right away. You have those little minor 5-minute downtrend lines on the futures. I showed you ES and NQ this morning, got out to you with the screenshotted posts right before this video, and I'll get to those again. And that could cause a near-term rally. Because they're 5-minute charts, does it have the potential to take us to new highs? Absolutely. But, again, bigger picture, the way I'm working this here, the way my brain is working, I'm going off. I'm going to take those bearish engulfings on faith. And so therefore, those are pretty significant sell signals in my opinion. And so therefore, I'm going to treat counter trend rallies as objective short entries, and I'll highlight those levels. Likewise, and I know you have a handful of contingents on the site that, perma bulls and just keep buying the dip, it's going to go up. That's fine. So then take the levels I'm giving you. I gave you a 5-minute downtrend line on ES and NQ this morning. Go long, buy those. I give you price targets, which we've been hitting on the way down on these short-term charts so far. Those are support levels. Buy those. You want to buy a dip? Take my analysis, and where I might be targeting short side targets on the downside, you can most certainly use those levels, because that's where you can find value. Is I can identify those support and resistance levels that you may or may not see, or you might see it and then I see the same thing. Oh, okay. And so whereas Randy's looking to short a break of X, of 100 or whatever the number is, I'm going to look to go long there on a pullback. So that's how you can trade. So right now, what I wanted to point out, I just showed you why I think 202.62 is a pretty good support level on IWM, and you can see here it's just been taken out. Now it's early in the day. We haven't even finalized one. The first candle of the day on the ETFs is a 30-minute candle, even on the 60-minute charts, because 6.5 hours in a trading day. So they goes from 9:30 to 10 is your first candle. Then they're hourly from that point. 11 o'clock print, 12 print on the hourly candles. And so you could snap above here, especially if those short-term trend lines are taken out. And then where would you look for if you're looking for more downside on IWM? Well, a gap backfill, or you can drill back down to those 5 and 15-minute charts that I've been showing you on the. If you look at the bigger picture, I'm zooming back out a little. This is a 60-minute chart, my go-to swing trading time frame, one of my favorites. We put in that divergent high there, and you had a primary uptrend line break. Primary again on the 60-minute time frame, shows on the daily as well. Breakdown, divergent low. See, this is swing trading, and this is what some folks just don't get on the site. This is you can put me in a primary downtrend, primary uptrend, and I will go long short all day long. That's really, I don't want to overly simplify it here. There are many variables involved in when to go long, when not to, when to go short, when not to, watching multiple indexes, watching other things, which I'm going to get to into this video. We're going to look at the Treasury bonds, of course, and some other things, but that's it. So most recently, we put in that divergent high. We had a trend line, major primary trend line breakdown and back test, rejection, counter trend rally. So far, it fell shy of the previous highs, put in the beginning of April right there. And again, this is a level right now on the more significant 60-minute time frame I'm watching. We go down to the shorter term time frame. Here's RTY again, just where I started the video today. Just make sure, and that's it. So far, they're holding that support as I expect. That was a pretty big target right there. Why? Major reaction low there, also divergent low, and you had this little. It's not a W pattern. It's not. It's just it was resistance, and then a big green breakout candle. So, I expect them to buy it here. Expect a reaction. It's got the potential, and here's another level. That's why again I do these videos. There's a lot of right there is a pretty clean trend line. It's quite a bit higher than those shorter term. This is an hourly chart. Remember, on the if I want to give you a comparable trend line, it would be right here. To the ones I gave you on ES and SPY this morning. We're going to get to those real quick. So that one, you break that, probably give you a little counter trend rally, especially if ES and QQQ or NQ break those. So there it is. Boom. It's already broken. There you go. So this is what I expect. That trend line got broken. And the way this works, guys, everything is in reverse now. T1, which was support way back here on Friday when I gave it to you on this 5-minute chart. Like I just said, if I thought it was support then, I am absolutely certain it was support, because we had multiple reactions. The more reactions you have on a support level, the more significant it is. And then support, once broken, becomes resistance. So all that, what am I saying? Here we are, push back to resistance. This is an objective short entry. So either this is going to prove to be a whipsaw. I can even take this trend line. Let me do something. Yeah, I'm going to do that right now in this video live. Why did I do that? Why did I move my trend line from where I gave it to you this morning? Because I had excluded this little reaction high right here. I slightly cut that candle off. Let me tighten it up here, nice and tight. I'm going to pull it in as I zoom in. Now I captured that reaction high, 1, 2, 3 from the highs, and so we're at resistance. Here it is. This is an objective short entry on NQ. Active trader could keep relatively tight stops somewhere above, or you could also add, again, whatever your plan is, if you're scaling in or if you're a bull. And we know there's some of those on the site. And hey, no problem. Best of luck to you. This is what you want to wait for a breakout. I can tell you right now with certainty, I can't tell you with certainty where the index is going, where the market's going, but I can tell you with absolute certainty, I believe this is resistance and this is resistance, your dual resistance levels. So what I can tell you with certainty are two objective plays right here. You either short right now, you're at resistance if you're so inclined to do so, or you hold off if you're bullish and wait for a breakout above that level, because if they can take it out with conviction, then yeah, you're probably going to run up to the next resistance level. That's how it works. It's that simple. All right, so there's NQ. Well, I modified the trend line, so now we're at trend line resistance to clarify, because I think that's a better fit. And then ES, I gave it to you on, this is a 15-minute chart, has not taken out that trend line. So we're going to zoom in tight. This is a 15-minute chart. I was just on a 5 a second ago. As I said to you in the post this morning, it's got divergence by the skin of its teeth, because you have equal, slightly higher, we'll call them equal lows on the indicators, RSI, PPO, and slightly, but definitely lower lows in price, and that gives us positive, aka bullish divergence, but there's your downtrend line, and we're still below it on ES. So that's another reason why, if I was looking to game this bounce, and who knows, maybe by the time I wrap this video up, and if I do it before I wrap the video, I'll tell you, maybe I'm inclined then, I'll cover shorts and go long, but I would not. I'm short at the moment, we'll stay short, and what would be bullish and probably bring us up even more if ES takes out this trend line. So what I'm showing you is we have the NASDAQ at downtrend line and price resistance on that 5-minute chart I just showed you, plus ES is not taking out the downtrend line. And although it takes the form of a bullish falling wedge, we're also coming off a much bigger divergent high. And then again, step it back a couple notches, we're coming off Thursday's bearish engulfing candles. And until and unless both QQQ and SPY, let's go to those real quick. That's the bearish engulfing candle. We have not taken out the top of those candles yet on QQQ nor SPY. And so again, if you want to trade that way and say, you know what, I think it has the potential to be tops, or I don't care, maybe I'm just going to mechanically trade this, and as long as we remain below those highs on Thursday, then I'll look to short rallies into resistance. Bulls can obviously buy a breakout above there, because they will most likely hit a bunch of stops if they can take those out. And if you are short, you might want to allow for a little stop rate. A stop rate is when they go up, clear the stops, and then reverse. But as of now, those candles are still intact. I spy with my little eye a bearish PPO, high-level bearish PPO crossover with clean separation. What I'm talking about, see the differential between the lines right here? That's clean separation. This is not. You had some high-level bearish PPO crossovers, but when these lines flatten out, they do that when you're in a very low volatility, either a sideways trading range or a low grind higher. So it's hard to extract any useful or clean buy or sell signals on the PPO. Again, you want to see these clean separations in the PPO. There was a bullish crossover. It was a great buy signal if you took it. It was clean separation lines. There was another bullish crossover. Even for a swing trader, we had a week of up there, all green candles, certainly a swing trade. I'm on a daily chart here, and this is the first clean high-level bearish PPO crossover we've had since. This one was cleanish right there. It was certainly a bearish, high-level bearish PPO crossover. There was some separation in the lines, as was that one. Both of those were followed by, this one was obviously followed by a bigger one. So this one was really the whipsaw. You crossed, went back above, and then that high-level bearish PPO crossover did the trick, and that was a tradable trend in SPY. Just wanted to point that out, that we have it. It hasn't happened yet. But it looks imminent on SPY if we go down from where we're at. QQQ's got a little way to go. The PPO is starting to curl down. And again, just one thing I wanted to point out there. So, that's what you often get on major turns. But it's a good tool. It's not a standalone. If it was that easy, you can set any automated trading program to buy and sell whatever index you're trading on just those. But I don't. I think you get whipped to death if you take every crossover. But again, you take it in conjunction with everything else. The recent bearish PPO cross. I'm sorry, the recent bearish engulfing candles, the big negative divergence on all time frames from the 60-minute out to the weekly and even monthly charts. Those are the things I look for. Okie dokie. What else? Just to reiterate, it's a lot of what I do. Still maintaining these targets. A pullback to the 200-day moving averages is likely, but if we pop the recent highs, then guess what? Again, if it's anything but a stop raid and you reverse, it's going to give us a marginal new high. It'll still be a divergent high. It's the same thing I've been saying since back here. Any new high will be a divergent high when you see the indicators lagging. When is it not? When these indicators start to go up and take out the other highs. So that's pretty exhaustive overview of the indexes. Here's my 15-minute chart. I'm just bouncing around time frames here for you on QQQ. There's that top of that bearish engulfing candle. You can see the divergence building. We came close to the previous high, and if you wanted, for all intents and purposes, even though it was not a new high or even an equal high, the divergence just continued there. And now you have a pretty clean uptrend line on this time frame. So this is again QQQ on a 15-minute chart. So I have an uptrend line right here, well defined, and then an almost parallel trend line down here. So if this one gets taken out, we'll probably head down to that second in parallel trend line. And that is about 3.7% below current levels right there. All right, what else do I want to cover? Let's talk Treasury bonds. I think I've given you enough on the indexes. TLT, the 30-year bond, rejected as expected off the downtrend line. This was a major level. Told you, added the long bond as a short here. You had a divergent high, negative divergence. Remember, we were long and strong off the lows, divergent lows on treasuries. Rode that up a good part of the way. Right there, we hit some resistance, started short in the 10-year because it had a downtrend line, comparable downtrend line, and then added ZB, the 30-year here at the downtrend line, and pretty hard rejection. What happened is they danced on it, kept testing it. The divergent high did the trick. It was a negative divergence that marked the turn, as it often does. Tells you a trend reversal is likely, just like the reason I was going long off the divergent low. And rejected, boom, boom, boom. Now, pretty impulsive rejection. What does this mean? This means rates are going higher. What does this mean on the 10-year? IEF kept us. Like I said, nothing's changed. We're still in my orange zone. We rallied up. Tried to test the top of the orange zone, which is resistance, 93.50, got rejected, and that was again. So this is the reason to stay short, keep a short bias on that equity markets, as I said I would months ago. We could milk that 8% drop off the highs right down to T2 where we bounced. I'm talking about QQQ, and that was because of this. We were in the orange zone. We rallied back up. Markets don't like rising rates. Markets like falling rates. Fed doesn't control the 10 and 30-year bonds. The Fed will cut. They will almost certainly cut this year, in my opinion. But they don't cut the 30-year bond rate. They don't cut the 10-year bond rate. They don't cut the 1-year bond rate. They cut the overnight federal funds rate. And so these rates are controlled primarily and almost exclusively by market forces. Yeah, they can be part of that market force. They got a lot of money, but ultimately they cannot. They don't have full and absolute control over the rates on the longer-term bonds. And however, the longer-term bonds certainly have an influence on the stock market, especially when yields are going up in an inflationary environment and you're seeing multi-year highs and yields are close to it. So that's it. Let's not beat a dead horse. We got rejected right at the top of the orange zone. It was an objective short entry, so you're profitable on bonds if you're trading bonds. And again, now what the stock market needs to see, what will probably make or break those bearish engulfing candles if you shorted the markets last Thursday or Friday after they were put in, either way, or today, this should be, quote unquote, should be net bullish for the equity markets. As if we get back up, this means yields are starting to drop, And this will almost certainly be. See, this can kind of be a go two ways, but there's not any. I don't have an alternative variation here. If this goes up and yields enter my red zone, that's going to be no bueno. I haven't changed this since months. I put this here back in February and said that's where the stock market will start to freak out. So I see no scenario. Of course, I can be proven wrong, but I see absolutely no scenario where we do this, we get into the red zone, and the stock market is happy. The only way that I see if we do go up here and get back into the yellow and then the green zone, which is net bullish for the stock market, the only way that happens and the stock market goes down is if this is a flight to safety. If the stock market starts coming down hard, all of a sudden hedge funds and mutual funds and individuals, or you sell your QQQ, you sell your NVIDIA, it all goes down. And if that starts to happen and there's a pretty clear and powerful sell-off in the stock market, you could see this scenario and it be not bullish. Instead of net bullish for the stock market, not bullish if that's a flight to safety bid. I've talked on that a lot, meaning institutions are selling stocks to get out of the stock market and to go into the safety of treasuries. And so that would be one instance where falling yields might not necessarily and probably would not be bullish for the stock market. And we've seen that before many times in the past. Again, it's called a flight to safety bid. So I've talked on that quite a bit. There's your levels. And just to recap, plain and simple. Despite the indexes being up near, their highs, it's very, very much to a large extent this and the technicals that I've been covering on the stock market for the last week as to why, I have both a near-term and still an intermediate and longer-term bearish bias. Okay, and now all the other things real quick. When I see all the other things, I've had a kind of a core, some pretty diversified mix of what I call core positions lately. The big stuff. Not talking about peripherals or little stocks here or there, individual equities or whatever. But been in recent weeks pretty clear on what I've been trading, and even when I've been stepping out of it. And those core things are crude, natural gas, agricultural commodities, primarily the grains, and then more recently miners, metals, and treasury bonds, of course, which I just covered, and of course the equity market. So those are the main things, and that's everything. Stocks, bonds, and commodities are your three major asset classes right there. So spread out. Just a quick update on GDX. Most recently, threw a trade ID out back here. Never took out that S3 to open the door for those additional targets. Instead, that support held, which so recently I re-highlighted it again with a new divergent high. And again, just a marginal new divergent high over that previous high anyways, by a very relatively small amount, again, relative to the move of what GDX does. Took out this trend line. That gave you an additional sell signal right there, or a sell signal. Hit T1, bounced as expected. S1 was first support. I would move this line. I will move it right now. I'm going to move it up right here. Why? Because I see this now as a reaction, and you had a reaction and a gap right there. So S1 support, remember, once broken becomes resistance. So let's change this, and that is now R1, or first resistance level. And T1 was effectively hit. Remember, you always want to cover a hair above the actual support level you're targeting. And so the next sell signal, even though that's an objective short entry at resistance, the next sell signal comes in a break at T1, which should open the door to T2 and or T3. Probably T3 is my guess, because I think there'll be a lot of folks, the momentum's stalling out here. Why did I say that? It's still in an uptrend. We're not far off the highs. These are your momentum indicators. That's what divergence is all about. Bullish. That's why we were bullish and long the miners right here off that low, and short the miners right there. I gave you, even though I had my crude annotations yesterday, I gave you updates, which I'll do right now on gold and silver. So no change from yesterday. I gave you as I've been showing you recently, 120-minute chart. That's 6 months of price history. Parallel trend lines also on this one, just like what I showed you on IWM earlier. There's a nice, clean, well-defined uptrend line. That was a big divergent high. This is gold, by the way, GC gold futures. You had roughly equal and or slightly lower highs on the indicators with higher highs in prices. That is negative divergence. So that is what we call a divergent high, as already pointed out to you. Breakdown, backtest, backtest. That's where we were yesterday. Highlighted that as objective short entry. And that's also a support level I've had here on this chart for a while. 23, roughly 23.38. We moved through it a couple times, but so when, if and when that goes, that should take us down to the next trend line and or, which is right next to it, that price support at 22.85. If so, that will be the next leg down in GDX to hit those second and third targets I just showed you. Will almost certainly correlate with that. If that goes, that's a bigger, more powerful sell signal if that support level goes. Right now, that's just what I'm focusing on. But again, was objective short entry yesterday when I highlighted, again today, and once we take out this recent low, we'll have clearly taken out that support level, and that should be a pretty quick swing down to that level there if that happens. Likewise, bulls want to see this level recovered, punch on up. All they have to do now is take out, make a new high, and they're going to take these divergences out, and then I won't have a, at least on this time frame, a strong case to make to be short the metals or miners. But that's not what's happened yet, nor is it my preferred scenario. All right, silver. Silver looks similar. You had this what looks like a buying climax right there, that kind of almost final vertical run right there, and then a very well-defined uptrend line, breakdown, back test. And so we've already hit this level once. That was a price support level or target I had on before 30.20, and I think that'll be hit again. Maybe one more reaction. Certainly a target. If you want to short silver instead of the miners, that's about a 6% drop. If and when that's taken out, I probably should add a level. I definitely could add a level right about here again for anyone trading silver. And again, this works in reverse, guys. For those of you looking to go long silver, gold, or miners, looking, all these support levels I'm showing you are potential, pullback targets to buy a dip on, right? Buy that, if that breaks, you can buy that, if that breaks, you can buy that. But based on this, we don't quite have divergence, but we have what I call an ADH, almost divergent high. If you put a flat line there, prices were equal. For all intents and purposes, that's called an equal high, and there's your negative divergence. So this gives us a potential for an even bigger drop in silver. Okay, back to natural gas. So we milked, hopefully most of you caught, the bulk of this 50% run. I don't have my targets on here anymore because we've now rolled to the Julys. Was previously we started buying the, I think it was the Mays, and then we were trading the Junes, and we hit those all the 5 targets I gave you on this 60-minute time frame. I think there were T5, and then told you, kind of look for a reaction. You had negative divergence. It was even if you wanted to, which I did, a short pullback trade, hit the trend line, took the trend line out, and we're dancing on this support now. But here's the thing, guys. We're just breaking support, and I told you I'd let you know when I got back in natural gas. Today might be that day. I haven't bought it back in yet. I'm watching this. What I would like to see is a recovery, and I think it'll probably do it. Snap back above this 274-ish level. And so then this will be a little false breakdown, aka bear trap. It hasn't happened yet. So if that happens, and then here I'm going to give the other level that should be bullish. I think the correction may be over natural gas. So 28.50 or 285. I'm sorry, 285. And so what happened if we reverse here right now? We'll see these potential. Again, they're not confirmed because PPO is pointing down. If we make a bullish crossover here, even a little lower, especially if we can also have it on the RSI, that'd look even better. It gives us a divergent low, and then that could set the stage for the next rally. So after booking profits, sidestepping that pullback, and even shorting a good part of it, I am warming back up, looking to probably get back into natural gas this week, if not today. And look, you can, again, don't take it now. I wouldn't, because you're right below, those recent reaction lows. You're below support. It's TA 101. Why not just wait till that support level's regained? You're going to entry slightly less favorable, but your odds are much better because then this has proved to be a little whipsaw. So hopefully that's clear. Crude, been long and strong crude. It's been one of my favorite top positions recently. And let me give you an update there. All right, so crude along off the trend line here. We tested that level for 1, 2, 3, kept the divergence getting bigger and bigger. And then we went on to pop the downtrend line right there. And so it's, about 8%, I think, off the recent lows right there, roughly, from our entry point. Remember, I had a first entry point was a little above the trend line. Then I said I'd prefer to see it get down there. And so it's about 6%. Nothing huge, but you take 6% in a few weeks, even in a month, multiply that, annualize that out, you're doing 72 plus percent a year, non-compounded. So that's what swing trading is. Get in, get out, hit and run. Anyway, I want to just point out that it's still constructive. I still like crude. We're still coming off that divergent low, and there's probably a little minor trend line we can add here. It'd be ideal to keep it above there, but if it breaks that, you would also have an objective add-on or re-entry on a back test of the trend line there. Obviously, at this point, we've had 3 successful tests of that recent low. You want to see crude remain above there. You want to see the divergence remain intact, and still maintaining these other targets. So there's your update on crude. Oh, let me do USO for you guys. I sometimes forget that a lot of folks trade the ETFs. So there's the same trend line. We bought it here off that divergent low, rallied up, hit the downtrend line. I updated it there, said you had downtrend line resistance, and you need to take that out. We pulled back off the downtrend line, which is what you do off resistance. Now we punched through it. So we've taken out the downtrend line just like on crude futures. And so therefore, same analysis as I just gave you on crude futures CL. Wheat, no change in wheat. Still has that divergent high. I told you I took profits here. I'm just kind of sidestepping, lightened up on the grains, and waiting to re-enter. Just not feeling it right now. It's working off. It had a big run, had a nice run off the lows. And as I say, stocks or securities. This is not a stock; it's a security, a commodity in this case. Can correct in one of two ways: time or price. Price, it's more bullish when you're in an uptrend, and the correction is only in time, not price, meaning you don't have a big pullback. I mean, we did pull back T1, not offered an objective entry, but longer term, as I showed you, wheat still looks constructive. If you don't want to actively try to game the pullbacks or sidestep the big drops, but what I don't like about it, we also have the bearish PPO. It's not a bearish PPO crossover yet, but it's getting close. There was a bearish PPO crossover after we were long here off that low, hit T1, T2, and then we turned around. I remember back then we shorted it again here. And it's these daily bearish PPO crossovers on the high level above the 0 line. We've only had 4 in the last year or two here. 1, 2, 3, and if this happens, that'll be 4. You can see what happened the previous time. So so I'm still standing aside for now. If we can power on through there somehow, I'd prefer to see a pullback. I'd love to see another run back to $6, really, to be honest with you. And so, you may want to run without me, and I may jump in later. But I just want to update it and say that, look, it's still, it's had a big run off the lows, 30%. We milked most of that. So it's, to me, just time to not get greedy on this stuff. And I don't know, sometimes, and me, I've been out lately. I've had a lot going on. Vacation week before last, family. I'm going to be going to Italy in less than 2 weeks for 10 days. I'll do my best to work remote, but now I've got to shoot back to Miami for an emergency passport. Found out we're sitting in the pool on vacation talking to someone, even though my passport expired July 10th, and I'll be getting back before then. You have to have a 3-month back end on your passport when you go to Italy, and 6 months in other places. I didn't know that. It's been a couple of years since I did international travel, but anyway, so anyways, what a mess, because I missed the expedited window. So there's I think 3 places in the country to do it, one in the state of Florida, and that's Miami. So now I gotta drive over there next Tuesday night. So I'll be a little bit I'll be working remotely, guys. I'm sorry to ramble. I just wanted to say that. So that's kind of me, been peeling back and booking profits on some things and keeping it relatively light on others. That's pretty much it. Yeah, that's pretty much it. Last week when we put in those, the divergent highs and the bearish engulfing candles, I highlighted the VIX futures. Remember, you can't trade the spot VIX. You can either trade VIX futures that are on the futures on the spot VIX. You can trade options on those futures, or you can trade the ETNs that then use the futures. My preference has always been the futures for various reasons, but there's a bunch of them out there. You can use whatever VIX track and ETN you want. I always say you don't need the leverage ones. A lot of people love those TVIX and 2-time leveraged. The VIX is the most volatile instrument out there. The VIX can go up 20% or more in a day. Why do you need the 2-time leverage? Anyways, that's it. So when it goes against you, it goes the other way. But trade what you want. I just wanted to point out this one broke out, like I mentioned last week, back tested, perfect back test, and it's been stair stepping higher. Obviously, the shorts from last week, which are new shorts, if you want to, from both the active trader entry and the bearish engulfing candle. Like I said, the VIX is a pretty simple beast, if you will. If you can, time, short trades on the market, then the VIX goes up. It's that simple. And it's like trading GDX instead of gold. It's going to go up more than the stock market drops. And likewise, when the market rallies, the VIX goes down. So the VIX, if you want to, and the charts almost are mirror inverses. So it's simple stuff. Bullish falling wedge, breakout, back test. And now we have the makings of a very near-term uptrend. Uptrend simply being defined as a security making higher highs and this higher lows really is what it's supposed to be. And so that's that. So the 1429 targets hit. We're coming up on the 1456 target. If and when these targets will be hit is contingent on whether my next targets will be hit on NQ, QQQ, ES, SPY, which I still favor and still maintain. So like I said, at most, we break those minor downtrend lines I started the video with, maybe get a counter trend bounce. If so, and you share the same mindset or view on the markets I do, then you could buy a pullback on the VIX, and that would be, you'd want to ideally time that with a rally into resistance on the NASDAQ 100 or S&P 500. Otherwise, the VIX has a kind of a history of when it wants to run, it can just really run and may not get you that entry you want. But again, my job here is to point out objective entry points, support resistance levels. Your job is to decide what to take, what to pass on, and how to do that. If you're got some bulls on the site and they might want to short the VIX into resistance here. We're coming up on that 1456 price target there, and if you think the market's going to go to new highs, then the VIX probably going to come back down and take out those previous lows. I don't think so. I made the case not only on that short-term chart, but on the VIX itself. We're at, as I mentioned it back here, we traded off there. It's to me a big support zone. We are at long-term support with big positive divergences in place that have only gotten bigger. Last time off that divergent low, the VIX rallied 81%. And this time, my expectation, the divergence is not only still intact, but it's even bigger. It's been growing. Therefore, looking for a bigger move in the VIX that would coincide with the pullbacks to those longer-term swing targets on QQQ, the 200-day moving averages, T3, T4, T5. You've got those three longer-term targets on QQQ. And that would most likely take us up to this downtrend line in the VIX, which would be off the recent lows about 100. It depends if and when you get there, about 130% gain. If we punch out the new highs in the market, if those little 5-minute downtrend lines get taken out and we go up and we start taking out some resistance levels, well, you still have, if we take out, we've been bouncing off the top of this support zone, you still have the bottom of the support zone down there. And then what I'll be doing if that happens, if we still have this divergence and we punch out in the markets to new highs, but we still have the negative divergence, I'm going to be saying the same thing I'm saying now. If we take out these divergences, we take out that support, then guess what? We're probably looking at a blow off top in the stock market. It'll probably take us down to that level. That was a record never before seen low in the VIX. You can go back as long as you want. That was a period of unusual low volatility, but this has been for many, many years the low end of the range in the VIX, about where we are now, roughly the 11-ish area, 11 to 12. And so you can see it on the weekly chart too. Big positive divergence, just like you have big negative divergence on the indexes. Last time we had positive divergence on the weekly chart of the VIX, other than this first divergent low. This was DL1 right here, and we got that, rallied into that downtrend line, right? That was that 80 whatever percent move I just showed you. It's the same divergence, even bigger. And the only other time in recent years was back in 2021, right there. And VIX hit this uptrend line and rallied from there about 180%. The time before that it had positive divergence was right there when COVID hit. COVID, as I said, might be considered a random black swan event as far as the, however you want to describe it, but it wasn't a random event in the stock market. It was, we had negative divergences, sell signals galore, positive divergence here on the VIX that I'm showing you, and it was followed by a 680% rally. Time before that was right here in 2017, late 2018, the Q4 drop, which we caught every penny of on the short side and then reversed at the bottom of that. That was a 445% move in the VIX. So I could keep going. You don't want me to. I'll draw another divergence. You can see, guys, this is pretty simple stuff. So that's it. So technical posture of the VIX says we're looking at a big move coming up soon, most likely, most probably, over 50% chance. I would put it pretty high, especially if we continue lower and those bearish engulfing candles hold and do mark a significant turn in the markets. I will end it here. This has been Randy Finney with Right Side of the Chart. Have a great day.